While most investors have been watching NIO's recent delivery numbers and debating whether the stock is overvalued, one of the biggest names on Wall Street may have just changed the entire conversation. Goldman Sachs has officially upgraded NIO to a high-conviction buy, and the numbers behind this upgrade are far bigger than most investors realize. According to the bank's latest institutional research, NIO could generate a massive 12.1 billion yuan positive free cash flow in 2026, a dramatic turnaround from the negative 3.1 billion yuan it reported just a year earlier. If that forecast is even close to being correct, it could completely destroy one of the biggest bearish arguments against the company. So today we're breaking down exactly why Goldman Sachs suddenly became bullish, what the numbers really mean, and whether Wall Street is finally starting to see something retail investors have been waiting for. And if you enjoy uncovering the biggest market-moving stories before they become mainstream, make sure you subscribe to the Daily Squeeze. Every single day we break down the hidden numbers, institutional moves, and catalysts that could impact your favorite stocks. Now let's dive into today's story. The biggest headline is simple. Goldman Sachs doesn't believe NIO deserves to trade where it is today. In its latest institutional report, the firm upgraded the stock from neutral to buy, while projecting revenue growth of roughly 60% year-over-year during 2026. But the revenue forecast isn't what really caught investors' attention. The real shock was Goldman Sachs's free cash flow projection. Last year, NIO was still burning billions of yuan in cash. Now Goldman believes the company could finish this year generating more than 12 billion yuan in positive free cash flow. That's an improvement of over 15 billion yuan in just 1 year. Why does that matter? Because free cash flow is one of the most important financial metrics institutional investors follow. Revenue can grow. Vehicle deliveries can increase. Even earnings can sometimes be influenced by accounting adjustments. But positive free cash flow means a company is actually generating excess cash after funding its operations and investments. For years, critics argued that NIO's business model wasn't sustainable because it consistently burned cash. If Goldman Sachs is right, that argument could begin to disappear. And that's exactly why this upgrade is attracting so much attention across Wall Street. But that's only the first part of the story. Goldman also believes NIO is trading at a significant discount compared to other pure-play electric vehicle companies. According to its analysis, NIO currently trades at roughly a 25% to 29% discount based on future price-to-sales multiples. Even looking ahead to 2027, the company still trades at around a 17% discount on projected earnings multiples. Now ask yourself one question. Should one of the fastest-growing EV companies in the world really be valued below slower-growing competitors? That's exactly the disconnect Goldman Sachs believes the market is missing. And when you combine that valuation gap with NIO's recent operating performance, the picture becomes even more interesting. During the first half of 2026, NIO delivered more than 191,000 vehicles, representing approximately 67.4% year-over-year growth. That's one of the strongest growth rates anywhere in the global EV industry. Meanwhile, parts of the broader electric vehicle market have experienced slower growth and increasing competition. Despite that, NIO continues expanding through its three-brand strategy, including the premium NIO lineup, the ONVO family brand, and the Firefly entry-level brand. Instead of relying on a single vehicle lineup, the company is building multiple growth engines simultaneously. That's one of the reasons Goldman believes current valuation multiples don't fully reflect NIO's long-term potential. But here's something investors should keep in mind. An analyst upgrade doesn't automatically mean the stock will move higher tomorrow. These forecasts still depend on execution. NIO has to continue increasing deliveries. It has to improve margins. And perhaps most importantly, it has to actually deliver the positive cash flow that Goldman is projecting. Fortunately, there are already some encouraging signs. Just days ago, NIO officially launched deliveries of its new 5-seat ES8, and early showroom data suggests customer response has been stronger than many expected. Internal sales telemetry indicates that a large percentage of buyers are choosing premium configuration packages, with more than 42% selecting the promotional bundle that includes 5 years of complimentary NOP plus driver assistance services before the July 31st deadline. Why is that important? Because premium software and subscription services generally generate much higher margins than vehicle hardware alone. Every additional customer choosing these packages improves the overall profitability of each sale. It also supports NIO's long-term strategy of building recurring software revenue instead of relying only on vehicle deliveries. And remember what happened just a few weeks ago. Many investors became worried after NIO slightly missed its own quarterly delivery guidance. The stock faced selling pressure as algorithms focused on that short-term headline. But Goldman Sachs appears to be looking much further ahead. Instead of focusing on one quarter, they're modeling where the business could be over the next several years. That's a very different way of valuing a company. Short-term traders often react to monthly delivery numbers. Long-term institutional investors focus on free cash flow, valuation multiples, operating leverage, and future profitability. That's why today's upgrade matters. It suggests at least one major Wall Street firm believes the market may be pricing NIO too conservatively. Of course, there are still risks. Competition inside China's EV market remains extremely intense. Raw material costs can still pressure margins. Global expansion remains a work in progress. And management still needs to prove that this projected free cash flow turnaround can actually become reality. But if NIO successfully executes its strategy over the next several quarters, today's valuation could look very different a year from now. That's exactly why this Goldman Sachs report has become one of the most closely watched developments for NIO investors this month. Now I want to hear from you. Do you think Goldman Sachs is finally recognizing NIO's long-term potential? Or do you think the market is right to remain cautious until the company consistently delivers positive free cash flow? Let me know your thoughts down in the comments. If you enjoyed today's breakdown, don't forget to like the video, subscribe to the Daily Squeeze, and turn on notifications so you never miss the next market-moving update. Thanks for watching, and I'll see you in the next one.